Hey everyone, this is Brendan Decima, owner of Decima Wealth Consulting. Today's video, we're going to touch a little bit on pension versus 401k structuring. So prior to 1990s, in the 80s and before, it was most common in retirement to live off a pension and Social Security. Most major employers, over 80% of them offered a pension benefit. And the nice part about that is it transfers that responsibility of retirement cash flow to a team of professionals and fiduciaries. So a pension is going to give you predictable payments. It's going to plan for longevity. You're not seeing the balance fluctuate day in and day out, so stress levels tend to be lower. But then in the 90s, a shift occurred, and corporations said, hey, why are we taking on all this risk? Let's transfer that risk to our employees instead. So instead of offering pensions, they offered 401ks. They started matching the 401ks. Now less than 10% of the Fortune 500 offers pensions. And there's a couple of advantages of that. We've seen a wonderful rising market, so balances are getting bigger and bigger and bigger. So that feels great, right? You have much more flexibility. You can take larger payments for renovations and travel and new home purchases, new car purchases that you might not have been able to do with a pension. So you just have all of this flexibility. You have growth potential. The downside is you're responsible for managing longevity risk, interest rate risk, market risk, and that can be a lot of stress to weight that responsibility on your shoulders. And what we've seen over the last couple years is a lot of these retirement strategies have just been taking on more and more risk. Risk levels are actually going higher. If you think about driving and you're just kind of smooth conditions, foot on the gas, and then you look at the odometer and you're like, holy cow, I'm going way faster than I thought I was. Well, that's what's happening to a lot of retirees' investment portfolios. Their exposure to tech is getting higher and higher and higher. Their exposure to 7 to 10 companies within their strategy is at levels that we have not seen since the 1970s, right? So just very big concentration risk, very high correlation, where if everything goes up, the portfolio goes up at the same time, but then everything is going down at the same time. It's not balancing risk. So I thought it would be helpful to share how the largest pension in our country manages risk and just how they're invested to manage longevity risk, interest rate risk, and market risk for $550 billion and, the entire, public state employee list. So the first thing that caught my attention is they have been reducing exposure to public equities. Things that are traded on the stock market is now less than 50%. It's been trending downward. As of the last report, it was less than 45%. They've been reducing exposure to bonds. Bonds is at 26%. They've held strong with real assets. So commodities and real estate hover strong around 15%. And then what's been increasing is private equity and private debt. So alternatives have become a much bigger weighting over the last 5 years. So the reason that I share this is so you can look at your own portfolio and see just how much exposure you have. Are you increasing exposure to public equities? Do you have more exposure in stocks today than when you retired? Are your bonds still playing the role that you want them to play? So historically, bonds play 3 roles in a portfolio: predictable income, stability against loss, and a bucket to rebalance. The last couple of years, we've seen double-digit declines in bonds. So are they providing that protection? Do you use them for stable income? And have you been using them to rebalance? If not, maybe we need to look at more commodities or more alternatives in the portfolio to hedge against that interest rate risk and protect against longevity risk. So again, this is not market advice. It's just educational so you can compare your own strategy to how the largest pension in the country is managing. If you would like to look at your strategy and you would like to explore commodities or alternatives or even transferring risk within your equity and bond portfolio, leave a message in the comments or email me. The email is brennan@decimawealth.com. If you enjoy, please subscribe. And I hope everyone has a wonderful day.